The market's saying 1 hike, and they're still saying 4 hikes, so they really have to kind of close that gap.
Are they going to do that today, though?
I think they have to, because I think one of the things that's going on is, we're talking about a rate rise, but credit costs have already risen dramatically since the third quarter of last year. So when you're looking at high yield costs where it's 10% now on average yield, and in fact, capital markets are kind of closed for very many high yield companies now. They've got to do something, I think, to loosen that up.
Can I just ask you a question, though, about how you play this? Which is to say, I was talking to some hedge fund managers yesterday who think we're going to hear what you said is going to happen this afternoon, and therefore the market is going to go on a little bit of a rocket ship briefly, and their view is to sell into it, because the way we've seen this movie play out, anytime the Fed has sort of eased, if you will.
So if we see stocks hop today...
Yes, they're going to sell out because their view is that ultimately the bad news actually is bad news, and that by the end of the week, we go on we on a roller coaster ride the opposite way.
So we've actually seen a 5% rally here in stocks in the last 4 or 5 days, in part
on this expectation.
We think the expectation is that the Fed has got to come off of this, 4 hikes in the calendar year that Fisher sort of set an expectation earlier in the year with the dot plot. So the rally may have already happened. It may completely be a, buy the rumor, sell the news kind of deal.
Since Draghi, and Draghi just
and
indicated
we figured
what
the Fed would have to follow suit. Right.
That not diverge too much, because that's what everybody is whining about. Is we're diverging from everyone else, and that causes currency fluctuations, which are hard to manage, and there's people on the wrong side of them and everything else. But we've rallied on the perception that it could even be one and done, and we had Dalio. What day was that?
That was last Wednesday.
Was that Wednesday?
Yep.
Yeah,
and he thinks we're going back to QE.
Well, another issue to consider is that
Draghi,
this coming Friday, we're going to get the flash report for the fourth quarter GDP.
Right.
We're at 1%. Bloomberg consensus is at 0.8. There's no way the Fed can tighten in March off of let's call it a 1% GDP number. They've got to wait for some improvement in the data, which is going to push them out into September, June, whenever the data begins to improve.
Philip, your point is a good one, though, and that's looking beyond just the equities market, trying to find out what's happening in these credit markets, particularly in the high-yield situations. That's a much more dire situation than some volatility in stocks.
Well, it is, because it's companies' costs of capital. And then if you look at things like bank lending as well, the surveys of senior loan officers, they're actually starting to tighten after a long time of loosening up. And so, for instance, where we're positioned in terms of fixed income, it's fairly defensive. Our biggest recommendations coming into this year have been muni bonds, investment-grade bonds, and bank-preferred stock, because we think banks are outside of this credit cycle. But that's a very defensive posture.
Sure. And Phil, you said you're very defensive when it comes to equities, too. What would you tell people to do right now?
Well, we've raised some cash. A neutral equity allocation for us is 60%. We're a couple of ticks below that. At various points over the last few years, we were up around 70 or 80%. For us to be sitting here at 57, 58% equities is signaling that we're very nervous about what's going on right here.